Hello everyone and welcome to your Glassnode video report, where today we're doing part one of the bear market survival guide. Now, this is going to be a multi-part series where we're going to be exploring the tools that are available to identify, assess the duration of, and try and find the bottom within a more bearish trend, which is where we currently are. So in this first session, we're going to be looking at navigation. This is very much about trying to identify the signs of a bear, trying to establish where we're moving into that hodler focus mentality and what that then looks like as we try to come out the other side of it. So really looking at where we are in the overall scope of a bearish trend. So we're going to use these on-chain tools, which really provide insight into the investor sentiment. And what we do see during a bear market is a general transfer of wealth from the weaker hands, people who came just for the excitement, into the stronger hands, the hodlers, the buyers of last resort. So what we're looking for in this particular session is trying to identify the characteristics of a bear market. We'll look at some of the supply dynamics and how that gives us a gauge on the overall duration. How long do we expect this to actually carry on? And then we're going to use things like lifespan metrics of a number of constructions to really try and understand what a bottom formation may look like. And that will lead us into part two, which we'll cover next week, which is a lot more about the actual bottom formation. What are we looking for to really establish that floor? And what are the signals that are saying that the recovery is starting to come out the other side? Now, for all of the metrics we covered today, they are going to be advanced. So anybody with an advanced subscription to Glassnode will be able to access all of these tools. We'll be doing this for all of these bear market modules, trying to just give everybody the access to the tools that they need and keeping all of the advanced level tools that most people have access to on the front and center. So just before we get started, please do give us a share, a subscribe, and a like. It really does help our channel. As I mentioned, we're always reading your comments. We are going dark mode, so everybody on Team Dark Mode can have their thumbs up. And I hope you enjoy this session. Do let us know if you find this useful, and we'll carry on with more of the parts as we press on. So where we're going to start this journey is really at one of the most fundamental metrics, which is our active addresses. And you'll see for a lot of these metrics, I've applied a 14-day moving average. And this is just really to smooth out daily noise. And we really care about the big picture here. We're looking less at the individual daily signals, more about what is the macro trend. Now, what we can see here is the very, very clear 2017 bull run. We had more and more users coming in on every single rally higher until we had the major collapse down that followed the peak in the bull. And really, this massive drop shows an expulsion of users. People left the system. There were fewer users of the Bitcoin network after this sell-off than there were going into it. And that's really the first shockwave that says maybe this is in fact different and we may have transitioned from the bull into the bear. Now you can see a very similar behavior in two different instances here. We had our 2020 and 2021 bull run where we had the very same peak here in May and then a significant collapse. We lost all of the bull market momentum and we pulled all the way back down to 2019 era. And you can see 2019 was very similar, but on a micro scale. We had a period of the bear where it was very, very quiet. People weren't overly enthused by what was going on. Fewer people coming into the network as prices go down. But as we formed that bottoming pattern, 2019 was almost a miniature bull run. We had our own little collapse down back into a miniature bear, and March 2020 fired off the next run. Now, where are we in the current cycle? We've seen the May sell-off, and you could argue that this major collapse in the user base really tells us that this bear market probably started around May last year. And it's showing that massive loss of user base, and it takes time for all of those people to find their confidence again. It may take them a year to actually get over that pain of seeing that 50% sell-off. And you can see that we've almost had a miniature 2019 bull, where we had this rally through August, September, into the November all-time high, and we've since started to cool off. Now note that we've established this higher floor in activity than similar to where we were in 2019, and the sell-off from the peak is not quite as severe. So there's a few takeaways here. We are still within this bear market channel. We're not trending up towards this overall bullish momentum. We're not seeing that same run at the moment. However, we've seen this kind of hodler mentality that only people who are left really are those who are the buyers of last resort. And what we're seeing is they're establishing this new floor of activity, even though price is down another 50% plus. So overall, in terms of the market cycle, there are some similarities to 2019. However, we still have quite some work to do. So there is a recovery that still needs to take place. And you could argue there's absolutely a bear market in play, as we've seen following that May point. And a takeaway fun note and a question to really ponder in the background, did we actually all-time high inside a bear market? Or do we need to reconsider what we talk about in terms of a bull or a bear? Was the rally from July all the way through to November actually a miniature bull? Was 2019 a miniature bull? Or was it all part of a macro bear market? These are some very interesting dynamics that there really isn't a perfect answer to. It almost comes down to how you interpret the data. So the way that I look at this, I believe that a bear market probably started in May just simply based on the expulsion of users from the network. And we're now probably in something that's closer to a 2019 miniature bull back into a miniature bear. And what we need to do is assess how that recovery goes from this point onwards. So now we're going to start by looking at the supply dynamics of a bear market. Now that we've really identified the ups and the downs and how the overall bear appears in terms of the on-chain activity side, we're now looking at how the coin supply moves. And in particular, we look at lifespan, how old of those coins are. Now, what we're looking at here is the metric called percent of supply last active 1 year ago. So these are all of the coins as a proportion of total circulating supply that have been dormant for at least 1 year. Now, this metric can only decline when those older coins are being spent. So because it's capturing 1 year plus, the only way this metric can go down is when those longer term holders, those older coins can get spent back into circulation. We typically see this during bull market trends. We see it here in 2017. We see it again here in 2020 and 2021. We get this large scale decline in these older coins as long-term holders and people who've been in the market for a long time distribute their coins and sell them to new hands. Now, eventually that creates an oversupply, and we saw this with the blow off top here in 2017 and with the rounded top, particularly in through April and May last year. Now, what typically happens following that distribution is somewhere towards the first third or the middle of the bear market. We can see it in both of these different instances. This supply starts to really slow down. Now, this is because of two different mechanisms that are in play. The first one is that those folks who own the older coins actually stop spending. They're starting to see more value as prices correct, and generally speaking, they're moving back into an accumulation phase. There's less spending behavior going on, so it's telling us something about the conviction. And we can see that we've gone through a somewhat longer period here all the way through 2021. It's been almost a bottoming process where fewer coins are being spent. Now, the second mechanism is that if we look at the bottom of this zone here, this was somewhere around May to July in 2018, which if we go back to May to July 2017, we were on the rally higher and notably at lower prices. This is back when Bitcoin was $2,000, $3,000, whereas up here we had a floor somewhere around 6,000 and bouncing between 8 and 10 at the highs. So the second mechanism as to why this starts to bottom out is folks who have held their coins for a year are starting to have those move into that 1 year plus supply. And as those buyers who accumulated all the way through the all-time high and then into the first phase of the bear, we see those coins continuing to mature into that 1 year overall cohort. So what we're seeing here is a general hodling and accumulation behavior, a willingness to hang on to their coins even though the market continues to trade down. So the rising of this particular metric is telling us a lot about the conviction of those strong hand buyers, people who may well be underwater. And we've seen in the data that there are top buyers who hold their coins the whole way down and ride them all the way back up again. So we do see that even though we're at all-time highs and the bear market is in play, many of these investors are hanging on to their coins, and simultaneously we have a reduction in the amount of new people in the market, as we saw with the active address metric. So in our current model, we've seen that we've had distribution through 2020 and through 2021. And really, as we bottomed out here in July, that's where we started to form this basing pattern. And again, it kind of speaks to this first third to the first half of the bear, which realistically probably started somewhere around May, at least from a network user perspective. Now, since that point, we've started to see this metric climbing quite substantially. And again, this is representing coins as we come into 2022. These are coins that were accumulated in the first leg of the bull. We broke the all-time high in December. And we saw that January and February were fairly large accumulation periods, particularly for vehicles like GBTC and various institutions that have very, very long timeframes, or in GBTC's case, where coins simply can't be spent. So what we're seeing here is this overall bottom formation, and the bear market looks like we're moving into that second phase where the accumulation is taking place. We're seeing that investor conviction seems to remain, and the amount of maturation of coins crossing that 12-month boundary is much larger than the amount that are being spent, because otherwise we would see a softening out of this trend, which is somewhat what we saw in 2019. We had a period of sideways where a number of these coins started getting spending, the overall accumulation slowed down, but then we moved back into the full scale accumulation and hodling just before we started the rally before the all-time high. So what we can see is that this can take some time, and depending on how we classify our bear market, was 2019 part of the bear? Was it a mini bear and a mini bull all compiled within a larger scale bear? But what we generally see is that we get this rising up of the older supply, which is really telling us two things: that the people who have older coins are spending less of them, which is showing conviction. And over the long term, there is a constricting of supply. And we can see that we're almost pushing up to, not quite, but soon pushing up to the all-time high of total supply that is locked within this 1 year cohort. So we are seeing that that conviction remains. And in the current cycle, it is showing that there is that constriction of supply that is starting to manifest in the space. Now, we can also then bring this back to a cyclical oscillator. We've talked about this transfer of wealth from young to old, from weak hands to strong hands, that we typically see during a bear market. Now, you may have seen this metric, which is called the realized HODL ratio, or RHODL for short. Now, what this takes a ratio of is the 1 week and the 1 year old realized cap HODL wave bands, which is a bit of a mouthful. Let's talk that through. So when we have a large amount of supply in terms of dollar value, so we think about it during the end of a bull market, coins are being revalued from the previous bear, much, much lower prices to much higher prices. So people's cost basis is much higher. And conversely, at the end of a bear, people's cost basis is slowly lowering. And as we just saw, there are more coins that are in that 1 year plus age bracket. So what the R-HODL ratio is doing is really capturing that phenomena. At the peaks, we're seeing that there is a large amount of cost basis or dollars invested at the highs in the 1 week old coins. This metric will trend higher when there's more 1 week old coins with a higher cost basis. Conversely, it will trend lower as more and more of those coins move into that 1 year old age bracket. There's fewer people coming in and buying in speculation, and we see this reset and it comes back down into this green zone. This is really showing that we're getting towards the late stage of that bear market. And you can see that in 2018, we also bottomed in and around the April, all the way through to the April period, where we had the 2019 rally that really kicked off. So we can see that this metric typically trades higher during a bull as we see more coins transition to the newer hands and the cost basis is elevated. And then what we see is a serious reduction as we move back into that hodling framework. And we can see that the main reason why this R-HODL ratio is breaking down so severely at the moment is actually based on the chart that we were just looking at. The amount of coins that are now reaching that 12-month-old threshold is really pulling down this metric. So the reason why this is resetting is because of all those coins that were purchased by institutions, by GBTC, all through that first phase of the 2020 and 2021 bull market. These coins that have remained dormant for a year are now increasing the amount of value that's held in that 1 year old cohort, and it is impressively large compared to the 1 week old cohort, because we've seen in the active addresses that there is less new speculation. So overall, that ratio is beginning to reset. So what we typically look for with the R-HODL ratio is a full reset coming back down into this green zone. You can see that we still have some time to go, but you can also see the pace and the rate of change and how quickly this is actually descending towards that objective. So it may still take some time. We may still have a number of months on the horizon for this bear market, but really this is showing that balance between the new speculative investor and the longer term hodler. Now we can also look at a very big picture metric. We're looking now at the concept of lifespan. So lifespan is for every coin that's in the circulating supply, how long has it remained dormant? So liveliness is a very big picture metric. It looks at all of the coin days that have ever been created, and it takes it into a ratio with all of the coin days that have been destroyed. So for every coin in the coin supply, it's going to accumulate 1 coin day per day. Now, some of those coins are going to be spent. And the older, in aggregate, when lots and lots of old coins are being spent, which again shows when that 1 year supply is on the decline, we will see liveliness climb. And the steeper this gradient is to the upside, the more age is being destroyed. So the older coins, the higher conviction coins, it shows that significant profit taking. And we can see that we saw this during the 2018 when we actually had the final sell-off. This was a panic sell. Lots of old coins came back to life because they were actually terrified that this was going to continue to trend lower. We saw it again during the 2020 and 2021 bull market, and we see the final stage of it here in the 2018 run as people finally flushed out all of their coins, realized profits, and then moved back into that accumulation period some months later. And the exact opposite is true. We get these large downtrends during a bear market, and this is because more and more people are accumulating. So if we start to combine these concepts, what we're looking for to really define the bear market is a drop in on-chain activity that's showing that people have exited the system, and it's mostly hodlers that remain. We will then start to see our liveliness metric and our lifespan metrics really start to decline. This is showing that those older coins are staying dormant. There's conviction returning to the market. And what that typically follows with is our 1 year supply starting to climb. And we see that supply constraint really coming into the market. So again, in our current market, we've had our 2019 and 2020 accumulation period around the same period of time as we started seeing our 1 year supply start distributing. We see our age starting to climb. So the amount of coin day destruction increases significantly. We peaked again around here in May, which is the same time that we saw all of the activity on the network drop off. We had a 50% correction. And what we've essentially seen is that those long-term hodlers who were more or less the last people who remained in the network started to see value, and we moved back into this accumulation period. So we can see a bit of confluence across a number of these metrics that's telling us a relatively similar story. Now we can see this concept of lifespan destruction and the relative scale of it in our coin days destroyed 90 metric. Now this metric captures the overall sum of coin day destruction over the last quarter. So it's trying to capture when are we getting this ebbing and flowing, and particularly as more institutions come into the Bitcoin space, we're going to start seeing things like annualized and quarterly results, and these types of things affecting the spending behavior of coins on chain. So we can see very clearly the bull market of 2017, where a great number of those coin days were being destroyed. This is a general exit by the smarter money. People who've held their coins for a long period of time are now exiting the system on this rally higher. Following that, we see a significant collapse in coin day destruction. This is where those hodlers in the bear market are starting to see value once again, and they're seeing that this actually may be the right time to be accumulating, or at the very least, slowing their spending. And remember, these low coin day destruction values signify both of those things, that there could be accumulation, and it also means that they're not spending older coins. So we have to deduce and try and make assumptions within this. And that's why we look for confluence across a number of different metrics, including supply dynamics, on-chain activity, and lifespan, to try and paint a cohesive story. Now, we mentioned before with our liveliness metric, we saw this very, very large capitulation event as we moved down here from 6,000 floor, which held for the entirety of the 2018 bear until we finally broke down to 3,000. And this shows the amount of coin day destruction. This is a real flush out, a true capitulation event where lots of coin days were destroyed. Even those who had the strongest resolve were flushed out during this moment. And often that can signal that we're getting towards the late stages of that bear where there are no sellers left. We see that 2019 had a very, very slight, again, speaking to this miniature bull market, we didn't really get a great deal of coin day destruction. Mostly these were people who had purchased during the lows or people who had purchased during the bear, essentially taking that exit liquidity because they were afraid that we were going to go back into that bear market. And for many of those folks, they were right because we did actually return to these lows, and you can see that our coin day destruction continued to languish. And this is really showing that there are people who are, even during the bear, not willing to spend their older coins. So again, it's speaking to that investor conviction that people would rather hang on to their supply than spend it. And in many ways, we've seen a very similar event. We saw our May capitulation event, which followed all of these old coins being spent. The market was flooded with supply and simply couldn't handle it. And following that, we moved back into accumulation. And many of these older coins have remained dormant, despite going through one and then a second 50% plus correction. So this is really telling us again about that supply dynamic. Because we're not seeing our Coinday destruction climbing, it is increasing the probability that we're going to see that 1-year-old supply continue to rise. We're seeing more coins going from young to old, and that means it's going from weaker hands to stronger hands. And overall, what this is painting the picture of is a probable supply squeeze at some point in the future. It's showing that until these trends start to really reverse and we see that loss of conviction, at the moment, the bear market is essentially following a similar investor pattern that we've seen in previous cycles. So it gives us that bit of a roadmap to understand what's going on. And as we watch the RHODL ratio pulling back, we start to look for when it's going to enter that sweet spot of the balance between old and new holders. And finally, we're going to close on a workbench metric. This is one that was developed recently by TXMC. So hats off to him. It was a fantastic metric. And there is a write-up that I'll leave in the description that you can look for more details on this. So again, you will find this metric inside our workbench as a preset, value days destroyed multiple. And what TXMC did is he brought that concept of Coinday destruction into the pricing realm and then developed an oscillator based on the annual performance. So it's trying to look at over the last year, how much Coinday destruction was going on, and then comparing that to the Coinday destruction over the last month. And what he really established is that when we get these all-time high peaks and the market gets really exuberant, we get these massive spikes of value days that are being destroyed. And we can see it here in 2017. We can see it here in January 2021. And following that, we get, similar to our active addresses, a collapse down. This is showing that overall long-term holders have stopped spending. They've realized that we've entered into a more bearish trend and we're approaching value, even if it's going to take a long time. Remember, these long-term holders have a long time horizon. They are willing to be patient, and that's why bear markets can be so painful. It can take a number of months, sometimes years to play out, but what we're looking for is those patient hodlers sitting there slowly accumulating, and it's about setting that time preference, following it within this data. Now, as we can see, as we get to the end of this 2015 bear, note how our value days destroyed starts to climb. We start to get a few higher highs and we start to get an increasing amount of Coinday destruction. And on top of that, the market is able to absorb that. So even though those older coins are coming back to life, the market has enough demand and strength to actually push through it. And really, this is what we're looking for. When we're looking for the formation of a bottom, we actually want to see the market able to absorb older coins being spent and the realized value that that's creating. So we want to see the market have enough demand to actually push through that. Again, 2017, we had the major collapse and we started to see this reversal in and around the very, very bottom as we push back above this zone. And this green bar that you'll see and red bar, TXMC ran a number of probability studies to actually assess how likely it is for the market to be undervalued or overvalued. So he's actually assigned probabilities based on historical observations. So we can use these models to really map out when we're getting to the later stage of a bear and when we're starting to reverse back into the bull. 2019 had a slight uptick. Again, it's almost this miniature bull market. Note that we didn't have anywhere near the same here in our 2021 rally. So it's showing that we're still kind of oscillating around this bear market territory. It's speaking more to a longer sustained period where we do have to see that strength return and the market absorb the sell side and actually start to trend higher. And this is a metric that we can watch for when it really starts to break northwards and get a bit of momentum behind it, showing that demand has entered the system and we can continue to trend. Until then, it's more likely that we're looking for a bottom to start forming, and it can take some time. So thanks for joining us for this session. Be sure to tune in next week for our part 2, where we're going to be looking at bottom formation and looking at a number of valuation metrics that can really signal when Bitcoin is getting into that lower form, when it's getting into that high probability zone where we have seen accumulation before. And what we're really looking at is this transfer of wealth over time. It moves from the weak hands to the strong hands. And really that strong hand cohort are those with a very, very low time preference. They are willing to be patient. And that is why bear market bottoms can take some time to form. So join us for next week. We're going to be looking at that bottom formation and various valuation metrics. And I look forward to seeing you then. Cheers.